Okay, we'll start on the second set of exams. This one I'm going to start is summer of 2007. Okay, the accounting equation, assets equals liabilities plus stockholders' equity, so C. What are the categories of cash flows that appear on the cash flow statement? You're not responsible for that. The answer is operating, investing, financing, but you won't see that on this exam. How are differing claims of creditors and investors recognized by the corporation? So the claims of creditors are liabilities, so those are correct. The claims of investors are stockholders' equity, so C is the correct answer there. Liabilities are defined as probable debts or obligations which the entity as a result of past transactions, not future. So probable, not possible. Anything is possible if you get down to it. So probable, not possible, and from past transactions. Which of the following events will cause retained earnings to decrease? Dividends will cause retained earnings to decrease. Net income will cause it to go up. Net loss will cause it to decrease. So both A and C are correct there. Okay. Question 6. Which of the following statements concerning the debit credit feature of the accounting model is correct? Debits are on the left. A debit entry will decrease a liability. That is true. And increase an asset account. That is true. Stockholder investors increases. No, it's recorded as a credit. A liability account should be credited on payment. No, it should be debited. So B is the only correct answer. Revenues are defined as ongoing operation. Increases in net assets as a result of ongoing operations. Revenue will always be recognized when it is earned. C. In 2004, Boeing Company reported total assets of $53,963 million and net sales of $52,457 million. In 2003, they reported total assets of $52,596 million and sales of 50256. So net asset turnover ratio was, so we take the average assets, 53,963 plus 52,986 for a total of and then we divide that by 2. That gives us our average assets of 53,474.5. And our sales for 2004. So we divide that by we divide the sales by 2. All right. So 52,457 divided by, I got 1. Probably 9.8. We did that right because it's a little bit smaller. Let's see. Sales of 53,474.5 divided by 53,963 equals, 98, 99. Be correct. You won't see this one. We didn't go over any of that. The difference between equipment account balance and the accumulated depreciation is called the book value. We did talk about that in class, but not a whole lot. One of the sections of cash flow, you don't have cash flow, but it is financing activities is the correct answer, but you won't see that. Net profit margin is net income divided by net sales. The primary responsibility for information reported by a company rests with the company's management. We've seen that one before. Which of the following conditions must be met for an item to be disclosed as extraordinary on the income statement? It must be unusual in nature, and it must be infrequent. So the correct answer is D. You won't see that either. The debt to equity ratio is computed by taking the total liabilities divided by total stockholders' equity. We talked about that really early in class. For each of the following items that appear on the balance sheet, identify as an asset, liability, or element of stockholders' equity. For any item that would not appear on the balance sheet, write in. Okay, retained earnings is on the balance sheet. That's a stockholders' equity. Accounts payable is a liability. A selling expense would not occur on the balance sheet. That's an income statement account. Contributed capital is shareholders' equity. Accounts receivable is an asset. Income tax expense is not. That's an income statement account. Dividends would not. That's a statement of owner's equity account. And property, plant, and equipment is an asset. Complete the following chart for Monticello Corporation. Investors purchase Monticello stock, so it would increase the assets and it would increase stockholders' equity. Use supplies previously acquired, and so it would decrease stockholders' equity as an expense, and it would decrease assets. Earn service revenue, that would increase assets either as cash or accounts receivable, and it would increase stockholders' equity as a service revenue. Purchased equipment on account, that would increase our asset and increase our liabilities. We paid expenses, that would decrease our stockholders' equity and decrease our assets. We paid cash. We paid a liability, that would decrease our asset and decrease our liabilities. And recorded a utility bill but did not pay it, that would increase the liability and would decrease a stockholder's equity. Number 18. On December 1st of 2009, Fleet Company paid $30,000 rent for some office space. I think we've had this before. Was debited prepaid rent. The rent was for 3 months, assuming Salem's accounting year ends December 31st. Give the adjusting entry. So we take the $30,000. We had something similar. Divide it by 3. And because it's for 3 months, that would be $10,000 per month. So December 1st to December 31st is 1 month rent. So it would be recorded as an increase in prepaid rent and a decrease in cash. And so now we would have rent expense for $10,000 and prepaid rent for $10,000. Number 19. Following information was taken from the income statement and balance sheet of Walt Disney Company. And so we have various things here. Compute the following ratios. Again, you won't see this, but I'll go ahead and do it. For 2004, so the net income is $23.45 divided by 30. 725 equals the gross profit margin would be 7.6%, 0.07, and your calculator is 7%. Asset turnover, total assets, so you have to get the average assets. So it's 53,902 plus 49,988 equals, we divide that by 2. So the average assets is 51,945. And so we're going to have the asset turnover will be 30,752 divided by 51,945. Is 0.59. The financial leverage is going to be what you have to do is get the liabilities. So the liabilities is going to be the assets minus the stockholders' equity. So 53,902 minus 26,081 equals 27,821. And so the leverage is going to be 27,821 divided by 26,081. Whoops. 27,821 divided by 26,081 equal is 1.07. And then return on equity is going to be your net income, 2345 divided by your stockholders' equity. And again, you have to get the average there. So it's 26,081 plus 23,791 equals, divide that by 2 is 24,936. So we take the 245 divided by 24,936, and that's going to be equals, let's see, return on equity would be 9.4%. Again, We didn't go over that. You won't see that. That's probably going to be on the next exam. And that's it for that one. Go to our last one here. And this is summer 2007. I think this one might have been a makeup, or the other one was a makeup. Which financial statement would you look to determine dividends declared? It would be the statement of retained earnings, also known as statement of stockholders' equity. Which of the following groups has primary responsibility for information? The company's management. You see, I've hit that several times. Assets are defined as resources with probable future economic benefits as a result of past transactions, right? Not future and not possible. On a balance sheet, assets are listed in order of ease of conversion to cash. We've seen that before. Which of the following liability accounts is not satisfied by a payment, is not usually satisfied by a payment of cash, and that's unearned revenues. We either provide a good or a service for that. The purchase of an equipment with a note payable would it would not do anything to cash, would increase the liability. Accounts payable account has a beginning balance of $12,000. We purchased $50,000 of inventory on credit. This month, the ending balance was 10. How much did we pay our creditors? Go to your T account. Accounts payable. Accounts payable is a liability, so the normal balance is $12,000. If we bought $50,000, so that's $62,000. We know our balance is $10,000 at the end of the period. So $62,000 minus $10,000, we paid $52,000, or B. Financial leverage ratio. Again, we won't have that. Don't worry about it. Financing activities. Again, that's a cash flow statement. You won't have that. If total revenues exceed total expenses, we have a net profit. The revenue principle requires 4 conditions to be met. Which of the following is one of the 4 conditioners? We do not have to pay for it. Delivery of goods, so that is one. The price is fixed or determinable. That is true too. So both B and C is the correct answer on that. That's weird because it says which one, and they give us 2, but C and B are the correct answer. On December 31 of 2007, Dallas Company recorded depreciation on a company truck of $5,000. Transaction analysis of depreciation should reflect. So it does decrease equity because the depreciation is depreciation expense. So that would decrease the equity, but it does not increase any liabilities. It does decrease the assets with the country asset accumulate, but again, it does not increase liabilities. We decrease stockholders' equity and we decrease assets. That is correct. So the depreciation expense decreases stockholders' equity. The accumulated depreciation decreases assets on that. This is a cash flow statement. You won't see that. That's next test. Granger Corporation reported assets of $5,200,000 and current liabilities of $2,300,000 long-term liabilities. Okay, so assets equals liabilities plus stockholders' equity. So our assets is $5,200,000, and our liabilities, we add these together, $3,500,000. If we subtract that, we get $1,700,000. So that one. 15, Dallas Company issued 200,000 shares of its common stock for cash. The entry to record the stock issue would include, okay, so cash would be a debit, and I don't see a cash debit, and then a credit to common stock. Okay, retained earnings comes from operation, common stock comes from people investing in our company. Okay, number 16, for each financial statement listed, enter check marks that reflect the debit credit concept. Assets will increase with a debit and decrease with a credit. Liabilities decrease with a debit and increase with a credit. Contributed capital decreases with a debit and increase with a credit. And retained earnings decrease with a debit and increase with a credit. Number 17, Harris TV Store had the following transactions in August. We sold 60,000 goods to customers and received 56 in cash. The rest are on credit. Okay. The cost of inventory sold was $36,000. The store purchased 16,000 of inventory, paid 12,000 for cash. Okay, so we're going to have our revenues are going to be 60,000 sales to customers. Rent revenue so August and September of 4,000, but remember we're just doing August, so it's only half this amount, 2,000. Expenses, cost of sales would be 36,000. That's just given to us. Right. They paid 16,000 for the month. So there's nothing that some was left over or any of that. So that's 16,000. And then utilities expense, we received a 2,000 bill for August, but it won't be paid. So it's the 2,000 there. And so the income will be 62,000. The whoops, does help to turn it on. 62,000 minus the 36,000 minus the 16,000 minus the 2,000. And so our income is 8,000. Okay, number 18. On November 1st of 2009, Bruce Company leased some office space to Fairlane Company and immediately collected 12 months rent in advance of $600,000. Bruce debited cash and credited unearned revenue for $600,000. At the end of 2009, give the adjusting entry Kane should make. So we have 600,000. Oops. Divided by 12 months. That's 50,000 a month. So this is November 1st at the end of 2009. So that's December 31st. So November, December is 2 months. Is $100,000. Our journal entry will be unearned rent revenue. 100,000. Got that a little close together. And our credit will be to rent revenue, $100,000. And our last one, well, this is another one, ratios. We're not going to have that, so you won't have to deal with that one. All right. So those are 4 tests, kind of give you a good idea of what's coming up, and we'll good luck to you. Good luck studying. I will be in communication by email, so if you have any questions, please feel free to email me. Get any questions about anything, and I'll get back to you.